Good morning, happy Monday, and welcome back to another edition of Accessible Alpha's Market Update, this time for the week beginning November 11th. On Monday of this week, we do have Veterans Day or Armistice Day, and while the market is not closed, it's certainly a good time to remember all of those who have sacrificed for our country. Quick disclaimer before we get started, please keep in mind that everything that I discuss in the YouTube video and obviously in the podcast is for informational and educational purposes only. Please do not construe any of this as investment advice in any way. It's simply insight into my process, what I take a look at, and should not be taken as investment advice in any way. As I did last week, what I'll do is a quick 3-minute, I said 1 minute last week, it's more like 3 minutes, and I think that's more accurate, a 3-minute overview of basically this week's update and some of the commentary. So if you only have a few minutes, you can get it here, you can get out of here. And if you'd like to stick around for the rest of the episode, I will basically just dive into more detail, into some charts, into some more analysis on these updates. Here we go, 3 minutes. First things first, obviously the big news event this week was the US presidential election on Tuesday. After Trump's win, markets absolutely soared. So the S&P 500 was up about 4.7%, the NASDAQ was up about 5.4%, and the Dow Jones Industrial Average was up about 4.6%. This was the largest weekly gain since the first week of November in 2023. Now keep in mind, yes, there's a lot of volatility around the election, but the volatility tends to wane post-election and usually throughout November's and December's, barring any other news events or current events that happen, there typically is a bit more stability in the markets as we finish out the rest of the year. Big sectors that did well after the election results were finance, tech, and discretionary. And these are actually great because these are very kind of offensive sectors. That means that folks are jumping back into equities and feeling great about the perceived economic growth of the country. Sectors that did not do so well would be materials, industrials, and utilities. There could be a few reasons for this. It could be that folks are jumping into more offensive sectors like, technology and moving away from the defensive ones in utilities, industrials, and materials. It also could be there is some uncertainty with Trump being our president-elect. What's going to happen with some of the tariffs, let's say, with a lot of the import-export that is required for these sectors. The other big news event last week was the Federal Open Market Committee, or the Fed, met on Wednesday and Thursday of last week, and on Thursday announced a 0.25% rate cut. That said, it seems like because the economy is so healthy, the dollar is doing well, there seems like there's a lot of perceived prosperity, especially with the new administration that is, will be coming to office. It seems like the Fed is going to be relaxing or shallowing their easing cycle. At least that's what the market thinks. The market is still pricing in another 0.25% rate cut at the December meeting. This according to CME's FedWatch tool. So we'll have to kind of wait and see on what actually happens with interest rates. But having a healthy economy is surely a good thing. A bit of news outside the US, the Bank of England also announced a 0.25% rate cut in its currency on Thursday. And last but not least, last week, yields remained strong in the treasuries. The dollar also remained strong, but obviously equities did really well as well. As we hit the last 2 months of the year, it will be very interesting to see if large institutional investors maybe give up the certain returns they'll get in fixed income, maybe to see, realize some of the growth in equities, or maybe they'll play it the way they have and take advantage of the high yields and fixed income. All right, so that's it for the 3-minute overview. If you have to take off, it was great to have you. Thanks for sticking around. But if you can make it, here's the rest of the episode. Crazy week last week in the markets. Kind of what we thought was going to happen is what happened. And what I mean by that is if Trump won, the markets were going to react very positively. That's exactly what happened. Sometimes when we have these elections, you can go back in history and look at this, and basically any charting software, you get some ups, you get some downs, you typically get a significant amount of volatility, which I'll talk about in a minute. This one was actually pretty cut and dry. If the election maybe went on for a few days and wasn't decided for a little bit, maybe that's where some of that volatility would come in. But as it happened, with Trump winning so quickly in a way, markets reacted really positively and really kind of stably as well, if that's a word. So that's really the big event that happened last week. So, as I mentioned at the top, markets absolutely soared after this. So the S&P, the NASDAQ, the Dow Jones, they were up there. It was their biggest weekly gain since November of 2023. So clearly the market was kind of waiting for this to happen, kind of hoping for this to happen. It did happen. Markets took off. And the whys behind that are relatively simple. Given, what Trump has said in the past, his first presidency, kind of what he said in his campaign, this time around, it really is about, theoretically deregulation. It's about more kind of economic stimulus, maybe a reduction in taxes. All of these things are good for equity markets, or really any market, and that's really why we saw the jump off that we did. As I mentioned, we also had the Federal Open Market Committee come out. They met on Wednesday and Thursday of last week. As we thought was going to happen, they did drop the Fed rate by 0.25%, and we actually think they're going to drop it at the December meeting as well. I kind of listened really intently to the press conference after the Fed rate drop announcement. So they dropped it at, it's 12 my time on Thursday, 2 p.m. Eastern time. And then at 2:30 Eastern, Jerome Powell came on and spoke about kind of, maybe the whys of dropping the rate. They don't get that descriptive, obviously, but clearly in the language. And something that he actually did say explicitly is that we have to keep in mind that the economy is actually really healthy. It's not like they are going to, and he's been saying this for a long time now, it's not like they're going to aggressively cut rates because we're in a recession and they need to provide liquidity to the market. He's basically saying that things are really strong. Unemployment has come down quite a bit. The job market is still cooling. And if you remember, cooling is basically the idea that the economy is healthy, but there are more folks trying to find a job than there are jobs available. And that competition is actually a good thing as long as it's kind of kept within a limit. And inflation, PCE, is also at 2.1%. And keep in mind that the Fed's mandate is to keep inflation around 2%. So basically what he was saying is that the economy is very healthy. There's really not a need to slash these rates very aggressively. And especially now with, President-elect Trump, having won the election last week, it wouldn't be surprising if they actually shallow out their easing cycle. So, a bunch of people asked what the Fed rates are going to be next year and how aggressively they're going to cut it. He clearly didn't say anything to allude to, what they're going to do next year, other than we're going to use data. Like, we're actually going to look at the economy. We're going to look at the reports. We're going to look and see how things are going. And then from there, we'll make our decisions accordingly. But we're not going to cut rates just to cut rates. We're basically going to take a good hard look at what's going on. And if we think that stimulus is required, we'll add it. But if we don't, we won't. So all in all, I think we're in a great economic spot. We're in a great economic spot for equities. The Bank of England also cut their rate by 0.25% on the same exact day. And the dollar remains relatively strong. Treasury yields are actually still pretty strong. And obviously the equity markets took off last week as well. So a lot of positive things, a lot of great economic strength. And now with President-elect Trump, kind of making his way towards office in January, it just seems like the economy, at least in the short term, is set up for some success. So, kind of all good things for markets last week. So as I mentioned, this is a slide I actually prepared a bunch of weeks ago. I had to cut it because, as I always do, I went over time. But I kept it around. This came from Edward Jones's weekly market wrap from 9/27. But basically all it shows is two things. And I think these are two questions that pop up a lot when it comes to trading, especially in equity markets, when it comes to elections and the candidates and the parties that they belong to and whatnot. I thought Edward Jones did a really great job of talking about this in a very objective way. The first is that we basically see on the left here, you're going to see volatility around elections. So here's just the VIX index, kind of 126 days before the election on the left, and then 126 days after the election on the right. The higher the VIX number, the more volatility there is in the market. And quite frankly, you see kind of what you'd expect. On election day, you see a spike in the VIX, a spike in volatility. And again, volatility could be ups and downs and all over the places. But then after we kind of get through the election, we get through to the end of the year, basically things level out. And that shouldn't be too surprising. Not only is the election over, but we're actually getting into the end of the year. And usually folks won't go too crazy at the end of the year. We do see some pretty strong Novembers and really strong Decembers, not only in election years, but typically in general. We spoke about that last week. But the volatility should be curtailed, at least for the time being. The other piece that is really interesting, the plot on the right basically shows, what was the S&P's total return for, the terms of president, basically from 49 to today. And again, clearly these are all terms, so they're, Republican and Democrat. Basically what you can see is there's not a huge difference. So a lot of folks maybe mistakenly think that if you have a Republican president, the returns are higher. If you have a Democratic president, then the returns are lower. It's not true. There's a lot that goes into it from a macroeconomic standpoint, from a news standpoint. Like, for example, we see in 01 through 08, we had George W. Bush, but we also had, with the dot-com bubble, we had 9/11, and then we had the global financial crisis. So, it really goes to show that it kind of doesn't matter who's, what party the president belongs to. The average 4-year return over that period is around 61% per term. As I mentioned at the top of the show, even with last week, the rise in equity markets, we're speaking of the equity market is basically their biggest weekly gain since November of 23. Treasury yields actually remain pretty high, and the dollar remains pretty strong. So on the left, I have the 10-year Treasury. Yields came down a little bit, floating around that kind of 4.45 level towards the beginning of the week, and then coming down to maybe 4.3. But that's still pretty strong. The yields are kind of higher than the coupon, meaning the bond's trading at a discount. And then the kind of euro to dollar remains relatively strong as well. Again, at the beginning of the week was a bit higher, a little over 1.09 kind of dollars to the euro. And then once we get towards the end of the week, as we would imagine, as rates come down, typically the dollar will weaken a little bit. And if the dollar weakens, basically what happens is I would expect the euro to increase, relative to the dollar. But because the Bank of England also cut their interest rate, maybe that had some effect on it as well. But long story short, towards the end of the week, it was trading at $1.07 dollars to the euro. So it came down a little bit, but not too shockingly so. And this is actually behavior that we would kind of expect when we have news like we had on Wednesday. All right, so flipping over to the indices, again, as always, I have the S&P 500 on top, I have the NASDAQ in the middle, and then I have the Dow Jones down low here. My crude yellow line is the beginning of the week, starting on the 4th. And like I said, there wasn't a ton of volatility. I mean, I guess you could call it volatility that, futures in the markets basically kind of went haywire the night of the 5th and towards the open on the 6th. But other than that, it's a pretty steady climb all week, which was especially nice for a long-only equity trader like myself. But it basically what we thought would happen, as I mentioned, kind of happened. When given what Trump has campaigned on with his theoretical deregulation of markets, with maybe cutting taxes. Obviously, the Republican Party in general is pretty kind of pro-economy. Again, I won't get into the long long-term consequences of that, because as we saw kind of last time around, if you are maybe too aggressive with economic stimulus, that drive in the economy actually can raise prices. Once you raise prices, you obviously get inflation, and then you need to raise the rates to curtail inflation. Let's not get into that right now. In the short term, we can say that clearly the market reacted very favorably to Trump being elected for his second term. As we get towards through the rest of November and into December, now that we're at market highs, it will be interesting to see if there's some profit taking, and the large institutional investors are going to be selling, kind of like we saw in the middle of this year. Are they going to be selling their positions, thus driving prices down, or through November and December, are they going to be piling back in? As we spoke about in a video a bunch of weeks ago, at this point, we're about 2 years into a bull run. Bull runs typically last on average around 4 to 5 years. Could this be the inflection point that folks were waiting for, that they were a bit reticent before? Maybe that's why yields were so high. They were getting into fixed income, but now they're saying, you know what? No, we're all in. We're back into equities. Who knows? So, the next couple months will really tell us the story there. But this week was surely a step in the right direction, at least in the sense of equity markets, for folks to be a bit more risk on towards the end of the year. All right. So for winners and losers, a bit of a different view this time around. Let me know in the comments if you like kind of this relative view. So this is how the winners and losers are doing relative to the overall market, which is the pink line. If you want to see absolute price, I can bring that back. Let me know in the comments how you feel about it. But basically 3 winners and 3 losers here. And these are actually fairly related to the election, at least a handful of them are. The first is Tempest AI. They were up 62% this week, which is absolutely enormous. Even relative to the markets, or at least the S&P's 4.6% that you see in that pink line on the bottom. Basically, Tempest AI, they build data analysis software specifically for healthcare, using a lot of novel AI tools to do so. They IPO'd, I believe it was this year, but clearly, the market really reacted positively, not only to their earnings down here, and you can see they actually kind of made up on earnings. They're still negative. Again, kind of a newer company from an IPO perspective. They kind of gapped on earnings a bit here. But then once the election results were read out, they really took off. They were at maybe 8.25%, 9%, somewhere around there. And then on the day of the 6th, which is really when the market kind of took off with the news of Trump's winning of the election, they went through the roof. So I think it's just a company to pay attention to. I'm not long in them right now, but their price action has been really good. Really going back to when they IPO'd, I believe it was earlier this year. It's just one of those stocks to pay attention to. Coinbase also gapped up quite a bit on Wednesday, the 6th. And really the reason here is that obviously Coinbase deals in crypto. Crypto is a very risk-on kind of offensive asset class. And with President-elect Trump coming back for a second term, generally what we'll see is that investors, given the kind of the stimulation of the economy that Trump is promising, these offensive kind of discretionary companies like Coinbase, and specifically the cryptocurrency asset class, are going to do very well. So they were up about 50% just last week alone. So think, if you have a stock that is more discretionary, or folks at least think about it in a more discretionary sense, but is fundamentally healthy and doing well and has room for growth, when you have this election like we had, or any sort of news that is going to promote an economic stimulus, I would expect that stock to go up, and that's surely what happened with Coinbase. The last one is Palantir. Palantir basically is in the business of, again, a lot of the data kind of analysis work, data engineering work. They specifically work with government contracts and, kind of super secret stuff, which is kind of fun. They are a very healthy company. They've been around for a while. So you can see they did announce earnings on the 5th, on that Tuesday, basically election day. They did well for Q3 results to beat on both earnings earnings and revenue. But clearly, if again, a tenet of the Republican Party is maybe to spend more in defense, with President-elect Trump coming back for a second term, clearly their market reacted well, not only to them beating on Q3 earnings, but probably having some earning potential for the next administration that's coming to office. They were up almost 40% last week. For the losers, at least two of them, I personally think that Moderna is kind of this there's two things happening here. The first is that they've actually been reporting a loss for quite a while now. I've done some reading into this. I am certainly not a kind of a pharma sector, expert by any means, but it just seems like they were kind of riding high after COVID. I'm not sure how much innovation has really kind of come out of Moderna since then. And maybe they're just feeling the pain of, not maybe having another product that's ready for market. I'm not sure. Maybe someone else out there knows far more about this than I do, and they can put something in the comments to correct me. But what is really interesting about this, that is certainly related to the election, is that both Moderna and I put Pfizer here as well. These are clearly very large vaccine companies, and with President-elect Trump coming back for a second term, he's made a lot of comments about RFK Jr., for example, coming into the cabinet, and RFK Jr. has made comments about basically, not being the biggest fan of vaccinations. I don't want to get super political in this episode by any means, but I think the market reacted to that. I mean, Moderna and Pfizer are big vaccine companies. Now we have an administration that's kind of coming into office that may not utilize vaccines maybe as much as we have in the past. It seems like the market reacted to both of these firms, and Moderna was about 15% for the week. Pfizer was down about 5% for the week. So not earth shattering, but clearly with the equity gains that we saw, you can see there's almost this like negative correlation between what the market did in this pink line, and what, Pfizer in this case did, in the bar chart down here. Other piece of news that I wanted to bring up, Constellation Energy. I've been following this stuff pretty closely, mostly because, personally, I'm just really interested in nuclear. I'm just kind of very bullish on the technology in general. I only have one holding in the portfolio right now that's directly related to nuclear, and it's not because I like it. It's because the fundamentals make sense and it was a good buy and this, that, and the other thing. In trading, it's really important to not let your kind of personal emotions or sentiment or whatever it is affect your trading. I always think you should be as objective as possible. But I've been following it because I do find it really interesting. For those of you who aren't aware, basically the movement now is that AI is going to require a boatload of energy, and certain companies that promote and build nuclear, facilities and reactors are coming forth saying, hey, we can utilize this renewable kind of sustainable energy source to power these resources, these AI data centers that are going to require a boatload of energy. The reason why I linked Constellation here is that Talon Energy was one of the companies that came in. They were talking about and have, started to put forth the plans to reignite, and get 3 Mile Island basically back online, sell that output to Amazon's data center. But FERC, which is a regulatory, I don't have what it stands for in front of me, but a regulatory kind of commission around nuclear energy, basically denied their request for the particular energy output that they needed to actually run that Amazon data warehouse. And that brought obviously the price of Talon down a little bit, but Constellation Energy was also brought down a little bit. Here you can see about 7%, on this chart. I think it was actually more like 12%, if you kind of do some reading in some of the reports. But that's why, when we look at the shorter time frames, you are going to see volatility specific to news. I am still pretty bullish on Constellation and Talon and all of these energy companies that are using nuclear, at least as an option, for, these very energy intensive, AI data centers. I'm just, we'll kind of have to wait and see what happens, with that. But anyway, again, maybe related to the election as well, but Constellation Energy was down last week. All right, getting over to, I'm not going to call it industry rotations because I'm not going to get into the particular industry groups. But again, with the election, I did want to highlight something that I said a bit earlier and kind of show a chart to explain it a little bit. Basically, we'll start with kind of the good news. Again, the pink line is the S&P 500. The candlesticks here, the bar charts are basically the individual sector ETFs and how they did relative to the overall market. And again, shouldn't be a surprise here, but the technology sector fared very well last week. Yes, the market was up about 4.6%, but the energy sector was up about 5.6%. The discretionary sector was up about 7.23%, excuse me, and financials were up about 5.2%. So again, these are really bullish, great signs for equity, especially long-only equity investors, because these are pretty, offensive, discretionary sectors. These are folks getting out of maybe the safer, which I've actually highlighted here, the materials sector, the consumer staples sector, and utilities. Obviously industrials are kind of in there as well and didn't fare too well. But hopefully it shows that investors are more risk on. Maybe they were waiting for the election to see how things were going to pan out, but it seems like they're jumping back in, which is a good sign for stock prices, rising in general. All right, so for next week, I basically just ripped this right from Charles Schwab's weekly traders outlook. They kind of do the week that was, and they do the week ahead, and I think they have some great analysis there. And I literally just copy and pasted it right from there. So thank you guys for putting that together. Basically, from an economic news standpoint, again, Monday the market is open, but it is Veterans Day. I call it an Armistice Day because I'm a history nerd. But really, what I'm paying attention to are the bolded ones here. We have the CPI reports, both CPI and core CPI coming out on Wednesday. What we are looking for is, again, inflation trending towards the 2% target that the Fed has a mandate to target, to go after. And then the second is the PPI, kind of the producer price index and core PPI, basically very similar to the consumer PCI, but just on the producer side of things. Like how much does it cost to make things relative to, the CPI is how much does it cost to buy things from a consumer standpoint. And then on Friday, again, there's a bunch coming out. I'm really going to be looking towards retail sales. I think the last 2 months we've had a 0.4% increase in retail sales month over month. And that's actually the long run average going back to about 1990. I covered that, I believe, in last week's video, maybe the week before. Again, I'm just interested to see what the appetite of kind of consumerism is, especially now leading into President-elect Trump's second term. In terms of earnings, we're basically done with Q3 earnings, but there's a few coming out that I thought were pretty interesting. I didn't bold them here, but companies, for example, like Alibaba, that they're going to be reporting on Friday. The same thing with JD.com. Some of these Chinese holdings, I'm interested to see kind of not only how they fared in Q3, but now with President-elect Trump, that him winning the election last week, what they're going to announce on their calls in terms of guidance and how they feel about what's next for them. And then, other companies I just think are interesting from a general sense would be like Cisco Systems. We have Walt Disney. So Cisco Systems is on Wednesday. Walt Disney is going to be on Thursday. Applied Materials is also an interesting company that, typically is pretty healthy. We'll see how they report. But really, next week for me is basically to see the volatility in the general market. I do want to see what happens with yields to see if maybe that kind of comes down a little bit as folks rotate into equities, and then clearly kind of the CPI and PPI reports. All right, trading tip of this week is kind of a funny one, but unbelievably important. It's not something like don't overtrade or, be patient. Those things are very true. But this one is maybe a bit more tactical, but unbelievably important. It's use a trade log. if you haven't seen a trade log, literally just Google it. A bunch of examples will come up, a bunch of frameworks, a bunch of templates. I actually put a screenshot of one here in the slide for those of you on the YouTube channel. It's kind of similar to mine, quite frankly. Mine's a little blown out because I do have a ton of notes, and I just like to keep a lot of detail around my trading. But even if you keep it simple, basically the idea of a trade log is learn from your mistakes. So a simple trade log is going to have kind of your entry price when you got into a trade, how much of, maybe how many shares you bought or how many contracts or, whatever kind of the unit of measure is for your asset class. And it will also say, when you got out, and why did you get out? And why did you get in? There's a column for, you should have one, I recommend, for why you got into the trade in the first place. Was it a great chart pattern that you saw? Was there a piece of news that came out that was really interesting? Is an industry kind of in vogue now and you've been waiting for an entry point? Is it at a market top? It doesn't matter what it is, but when you have a set of rules for your trading, and you should always have a set of rules for your trading, a trade log basically enables you to cite which rules you kind of use to get into a trade, and then do the same thing when you exit a trade where you stopped out, or did you make a ton of money and you just wanted to kind of sell off for some profit. Be explicit with why you did what you did. And then what you'll realize is that, and it should be evident, but trading is a learned skill. And it's a learned skill because you can learn from your mistakes, but you need some sort of document or some sort of tool that enables you to learn from your mistakes. So use a trade log. I know it can be a pain to fill out. I literally use mine every single day. Every trade that I make, regardless of the asset class, if I'm doing something experimental, if I'm trading client money, whatever it is, it goes in there. And the idea is that you can basically really have an idea of when you do well and when you do not do well. And when you do not do well, you have a note, you have a record, so you can go back and rectify those issues. All right, as always, thank you so much for supporting our channel at Accessible Alpha. If you can, if you're on YouTube, please like the video, subscribe to our channel. These come out every Monday morning at 8 a.m. Eastern time. And share it out. If there's somebody that you think could benefit from learning a bit more about trading, or maybe just some market commentary and analysis, that would be helpful. Please then make them aware of the channel. It would be really helpful for us. If you're listening on the podcast, either on Spotify or on Apple, please rate the podcast. That really helps. Always feel that you can join our Discord. So the Discord invite link is in the description of the YouTube video. Come on in. We're always chatting about markets and trading tools and techniques and all sorts of different things. It's basically a way to have an ongoing discussion throughout the week, instead of maybe in the YouTube comments or something like that. So as always, thank you so much. I'm excited to see how the next couple of months basically pan out with the election results from last week. And best of luck next week. I will see you soon.